This is a very important topic that we're discussing today because a lot of people struggle with managing cash flows post-retirement.
In retirement, I think the requirements change, right? When you're building wealth, the objective is to grow the wealth. The objective is to reach a certain number, get aggressive with investments. But once somebody retires, then what they need from their portfolio suddenly changes.
Absolutely.
They need safety of the capital, and then we need cash flows regularly. What most people don't say they need it, they actually need it, but they don't realize that they need it, is that this cash flow should also grow every year.
If you are 30 years old and you are earning a certain income, you have certain expenses, you're saving something every year, you're building a portfolio for a purpose, which is, let's say, growth. There are also a lot of factors have to be considered. What kind of asset classes is the best suited for you at that point, etc. If you outlive your wealth, you will be in trouble at some point. And so the portfolio construction will now be based on factors, which is longevity.
3 crores, how much can I comfortably withdraw?
The second factor being people are also thinking of retiring early. The concept of FIRE has come in. So they're like, why do I have to work till 60? What if I retire at 50?
Live with 75,000 instead of 1 lakh.
The number at which you're retiring, the corpus is finite.
So there is this, like they say in India, cricket, Bollywood, and fixed deposits are our favorites, right?
FDs are convenient. You know, there's a bank next to you and you place an FD. You typically know the manager there well, so you feel extra comfort that somebody is looking over your money, which is not really the truth. If you purely look at numbers, if you look at factors like taxation, liquidity factors, then fixed deposit is not the most ideal fixed income product available. There are products available where you can safeguard your capital, earn similar rate of return that you will get from FD without compromising on liquidity and probably with a little better taxation also.
But they're still mutual funds, and so they are subject to market risk.
Yeah. If you're talking about a black swan where a government goes into bankruptcy or something.
We've had a client who walked in and said, can I top up my annuity and get regular income?
The idea that the capital should remain safe and intact, there is certainty, but that certainty doesn't necessarily mean efficiency. But even the developed countries today, we are looking at US, we're looking at China, we're looking at Japan, we're looking at UK, Germany. Even though they have developed over a period of time much before us, their inflation is still ranging at around 2.5%, 3%, 3.5%, 4%.
In House of Alpha, I do the adding new goals into the plan, and then it's his problem to figure out how to handle it.
When your income is active, when your life is very active as a working couple or a working person, then your portfolio has to be very active. And when you go into a passive mode where you're kind of not having active income, then your portfolio also becomes passive. It's exactly the opposite.
Balancing return requirements and risk. Don't start your retirement plan with a calculator, but start with the calendar. Welcome back to ReFirement Talks, and today we have Harish Menon, my business partner and co-founder at House of Alpha. He's an investment advisor, chartered accountant, CFA. He's been in the industry doing this work for a very long time. He specializes in creating interesting cash flow structures for retirees. So thank you very much, Harish, for joining us today.
Thank you, Bhuvanaa. This is a very important topic that we're discussing today because a lot of people struggle with managing cash flows post-retirement.
Yes.
And I believe it is not just about numbers. It's a lot about restructuring the framework, not just mental, but also how your portfolio has to be designed. So very critical topic.
Okay. So let's just dive into this. Let's say somebody is retiring now, is 60 years old and has about 3 crores in assets, all your EPF gratuity, retirals, everything put together. How much can they reasonably expect to get as a regular income every month?
So the figure would be close to about 1 lakh rupees per month if you're talking about 3 crores. It's based on some numbers and mathematics that works.
So 1 lakh is 12 lakhs, 4%. Is that what you're saying? 4%?
Correct. So annually, if you have about 12 lakhs of expenses, which is about 4% of 3 crores, you should be more or less fine.
Yeah.
It has certain assumptions, however, and the assumption works on a very critical number called inflation. Because you are spending 1 lakh this year every month, but it may not be 1 lakh every time. It will keep on going higher because of inflation. what we assume in this calculation is that inflation is at 6%.
Okay.
So if you're at 6%, and if your portfolio is designed in such a way that you earn just about 1% extra returns, which means your portfolio grows at 7%, then for the next 30 years, you will be able to safely withdraw about 1 lakh rupees.
Okay.
And your 3 crores will essentially be able to do that. So there are assumptions we have to make in this. There are a lot of other assumptions also.
Okay.
This is essentially the basic number calculation that will come to.
So you're saying inflation, we should assume 6%.
No, this calculation assumes 6% to make it 1 lakh. I have taken like the India inflation at this point, which is close to 5.5, 6. Inflation technically is very different for everybody. So when we speak to a lot of clients, their actual expenses may not grow up at the same rate as India's inflation.
Exactly.
Because everybody's lifestyle is different. So we have something called lifestyle inflation also.
Yeah.
So if you're going to live very lavishly once you retire, probably the same way as you were living, let's say when you were in 30s and 40s and income was flowing. And if we see that your inflation is actually growing at 10% year on year and not 6, then this 1 lakh rupees I mentioned earlier will not be the figure. It will not happen that you can safely withdraw 1 lakh and the money will last till 30 years. The money will run out much faster if you suddenly grow at inflation of 10%, or you'll have to change the portfolio mix accordingly.
So, but you mentioned something. You said an inflation of 6% and a return on your portfolio of 1% more.
Correct.
So even if inflation is 10% and the return on my portfolio is 11%, I'm okay, right?
Correct. Now, the moment you change the equation from portfolio requiring 7% per annum to portfolio requiring 11% per annum, you're suddenly bringing in a lot more risk.
Correct.
In the earlier case, I mentioned that just this 1% extra, you will last comfortably.
Yeah.
But if you have to earn 11%, then the kind of asset classes you will go into will typically have market risk also. Then we have to consider risks like market crash, etc., that will hit your numbers again.
No.
So 6, 7, very comfortable. 10, 11, the comfort is not the same. The probabilities change. The probability of money lasting will change because you're suddenly adding a lot more risk factors into your equation.
Correct. So I get what you're saying, because in retirement, I think the requirements change, right? When you're building wealth, the objective is to grow the wealth. The objective is to reach a certain number, get aggressive with investments. But once somebody retires, then what they need from their portfolio suddenly changes.
Absolutely.
So they need safety of the capital, and then we need cash flows regularly. What most people don't say they need it, they actually need it, but they don't realize that they need it, is that this cash flow should also grow every year, adjusting for inflation.
Correct.
And then it should also be easy. Maintenance has to be comfortable. You don't want to pay too much taxes. So there are a lot of variables and moving parts that need to be taken care of when building the portfolio.
Absolutely. So even when you're building a portfolio, let's say at a growth stage, if you are 30 years old and you're earning a certain income, you have certain expenses, you're saving something every year, you're building a portfolio for a purpose, which is, let's say, growth. There are also a lot of factors have to be considered. What kind of asset classes is the best suited for you at that point, etc. As you rightly said, not only the mindset has to shift of this particular person who's retiring, which is very important, the portfolio also has to shift now. The role has changed. Now it's not about trying to accumulate more wealth. It's more about whatever I have, can I ensure that this will last my lifetime? That's the biggest risk you're living with, because if you outlive your wealth, you will be in trouble at some point. And this generation do not want to go back to their children for retirement. So they need to ensure their money lasts. So the portfolio construction will now be based on factors, which is longevity. How can I ensure that while you withdraw from this portfolio, it still lasts?
Correct.
The mix has to be accordingly created. And you need to understand that this portfolio is now designed to be withdrawn from. It's not like you will leave this portfolio behind. So you have to change that mindset and say, over a period of time, I am okay to see this portfolio value going down because I'm withdrawing from it.
Correct.
And that is the purpose. So you have to be comfortable with that.
Yeah. So you mentioned a very important word saying, how long will this last, right?
Yeah.
So when even the first question that we were asking, 3 crores, how much can I comfortably withdraw?
Correct.
I think the underlying statement there is that how much can I comfortably withdraw and ensure that I can keep withdrawing that money for another 30, 40 years. So
Correct.
the longevity of the money is a critical thing. And do you think in recent years, the longevity has become a bigger issue or...
Yeah, for 2 reasons. One, life expectancy itself is going up with science, better healthcare, access to healthcare, etc. So, in let's say 2 or 3 generations before, if the average life expectancy was, let's say, 55, 60, let's say 50 years back, now it's more like 68, 70 for normal Indians. And when I say normal Indians, we are talking about an average Indian who could also be living in a rural area.
Correct.
If you're in a city, if you have access to all the medical facilities, if you have money, if you have insurance to access it, I think the life expectancy can be as high as 80, 85 also in today's world. My dad, as we speak, is 85, and I don't know whether he planned for it when he was managing the retirement, and I am his retirement plan as we speak. So as I said, if you have to think about life expectancy till 85, 90 conservatively, the second factor being people are also thinking of retiring early. They want to retire early. The concept of FIRE has come in. So they're like, why do I have to work till 60? What if I retire at 50? Of course, they may do something else, but their active income predominantly stops. So if you retire early and life expectancy also goes up, we are in some cases looking at this retired period of almost 35, 40 years.
Correct.
So when I said 1 lakh out of a 3 crore, I assumed about 28, 30 years.
Okay.
If someone were to do this calculation when you're 50, with 3 crores and living till 90, the money will not last. So it's very critical, as you said, to look at the longevity part and work backwards.
So if somebody is retiring early, then they should be willing to live with 75,000 instead of 1 lakh. Is that what you're saying?
Or look backwards and say the corpus may not be enough for that. So you have to start by doing the budgeting. What is that number that you're going to be comfortable living with? A lot of expenses may continue even after retirement. Just because retirement happened, you may not probably stop spending on food and eating out and all. But certain expenses will come down. You might want to add more spending on, let's say, travel because you could not get time earlier. So you take your ideal lifestyle and see what is that number. If that number is achievable, great. Otherwise, you'll have to obviously tweak something. So we have finite resources now because the number at which you're retiring, the corpus is finite.
Yeah.
Then you have to now work backwards. So
Move
as
other
they say,
things
you can only stretch your legs till till your blanket can afford, essentially. So retirement will add that constraint of not being able to suddenly increase expenses because you don't really have a lot of extra income coming from. So you're working with constraints, but doesn't mean that you have to be worried about it. You can plan it, you can structure it, and then you can ensure that it works.
This is a very relevant point that you're mentioning, the worry about running out of money.
Yeah.
So there is this, like they say in India, cricket, Bollywood, and fixed deposits are our favorites, right? So when it comes to people who are retiring, there's a lot of comfort with keeping the money in FDs. I mean, we've seen some of our clients have crores of money lying in FD. They will not move that money out. You can say anything you want to say, but there's this love affection to FDs. How do you see that as, is it empowering? Is it derailing the plan?
So FDs are convenient. I mean, that's the starting point. You know, there's a bank next to you and you place an FD. You typically know the manager there well. So you feel extra comfort that somebody is looking over your money, which is not really the truth. If you purely look at numbers, if you look at factors like taxation, liquidity factors, then fixed deposit is not the most ideal fixed income product available. There are products available where you can safeguard your capital, earn similar rate of return that you will get from FD without compromising on liquidity and probably with a little better taxation also. Because in FD, it becomes illiquid. You're getting, let's say, 6.5%. But you have to keep the money locked in for, let's say, 1 year. If you break it in between, the 6.5 doesn't remain 6.5. Secondly, this FD interest is taxed in your hands, whether it is accrued or whether it is withdrawn. So every year you have a tax component. There are products where you can avoid all this thing, keep the safety part as it is, improve the liquidity, improve the post-tax return. So if you have certain features kind of dominating something else, then by default FDs do not become the best product, no matter how much uncomfortable the investor may be to shift from it. We will have to keep educating them and make it happen, because there are definitely better products available than FD.
You're talking about debt mutual funds.
We're talking about debt mutual funds. We're talking about arbitrage funds.
Okay.
We are talking about even conservative hybrid funds, if used well. All of them can beat FD in a lot of features and factors as compared to just keeping the money there.
But they're still mutual funds. And so they
They're
are
still
subject to market risk.
Yeah. That's a disclaimer that you will see.
Yeah.
But again, if you have the right advisor or if you have the right knowledge about these mutual funds, you can easily pick safe mutual funds. And when I say safe, truly safe, I'm not talking about safe if 5 factors work. Safe in most cases, unless we are talking about a black swan where a government goes into bankruptcy or something, you will be able to replicate FD-like returns with safety, with extra liquidity where you can withdraw anytime. And as I said, the taxation can be better in products like arbitrage funds.
Correct. And there's a lot of love for annuities also. And also given that a lot of companies or NPS or a superannuation, you have to necessarily convert it into an annuity plan. And we've had a client who walked in and said, can I top up my annuity and get regular income? So there's a lot of comfort. So they say the moment your paycheck stops, then every penny starts mattering. And the annuity payouts feel like a paycheck. And I'm also keeping my corpus intact, right? So there's this reluctance to take money out of the capital. Can I just live out of the interest earned? So what's your thought about annuity plans?
So the idea that the capital should remain safe and intact and I should earn something out of that consistently is a great thought. That's an ideal
in the ideal world
that you would want in the retirement corpus. The factors you have to consider is much more than that. How much are you getting every month on this? What is the rate of return that you're earning on this?
They're not earning very well, right?
Annuities do not earn more than fixed income products typically, because they fix up a particular rate and they are committed, the annuity providers are committed to give this number till the time you live. So there is no upper end to it. They don't know whether you will live for 20 years or 30 years or 40 years. They will do a lot of what is called as Monte Carlo simulation, which is estimating the future in some way and fix a number. And they will be conservative at that because they don't want to commit a number which they can't pay after 25 years. So
but they're 99 years, right? So that's when they will stop.
Which is much more than what we will normally assume for a normal person to live till. So from 60, if you're only going till 85, that's 25 years. But they will have to do the calculation till 99 and that will make the amount slightly conservative. And you cannot change it now. So once the annuity number is fixed, whether your expenses go up tomorrow, whether the rate of inflation you assumed goes up tomorrow because of some other factors chipping in, you can't change this figure now. So you cannot reverse it also now. You cannot just go back and undo it. So there's a lot of rigidity in this entire cash flow generation that you have done. There is certainty, but that certainty doesn't necessarily mean efficiency. Comfort is not the only factor you look at. You also want to see whether this is the right way to do this. So annuity, unfortunately, the way the pricing works, the way the assumptions work, the rate that you eventually earn will be something close to 5.5-6%, which I know is not really
which is
very
not
high.
that 1% more than inflation.
Exactly, which is 1% more if your inflation is at 4% year on year.
Which is
then it's the best product. Then you can just stick on to it and you will have no issues. But you cannot be sure about that. Inflation can swing. We are living in a very globalized world where wars are happening. Oil prices can shoot up. India still remains an oil importer. Whether you consume it or not doesn't matter. Prices of vegetables can still go up because of, let's say, oil prices going up. So there are a lot of factors that can touch inflation. You don't want to lock into a certain rate of cash flow for the next 30, 40 years without having a chance to move it. So annuity can be a part of your retirement portfolio, but putting everything in it will not be an efficient portfolio.
Interesting, because I've had a client who came and said that his father bought an annuity in the mid-90s and it pays 12% and he still continues to get, while inflation rates have only gone down, right? And as the country grows, that's what we expect, inflation rates to keep going down.
Correct.
So doesn't it make sense to lock in at...
It does, but From 12, you know that there is a lot of scope to go down over a period of time. From 5.5, 6, I don't think that is going to happen. We are not going to see a deflationary India at any point. I don't expect that to happen.
In our lifetime, at
In our lifetime. So next 50, 60 years, am I going to see India suddenly going into a degrowth mode? I don't think so. We will, as you rightly pointed out, as we grow, we will have lower GDP growth. We will have lower inflation. But even the developed countries today, we are looking at US, we're looking at China, we're looking at Japan, we're looking at UK, Germany. Even though they have developed over a period of time much before us, their inflation is still ranging at around 2.5, 3, 3.5, 4. So for me, the factor is going from probably 5 of 6 to something like 3 of 4. And this is not even considering, as I said, lifestyle inflation. This is average India's inflation. And India is still, unfortunately, a largely poor country. So you can't put your consumption basket and compare it with the consumer price inflation and say, okay, this is what I'm consuming. I don't think anybody in middle class or upper middle class is consuming that. So to start with, I think our inflation is already 1 or 2% more. So if India is at 5 of 6, you're probably at 7 of 8. And then you pick an annuity which is at 5.5. Maybe it will give you some comfort 25 years down the line. Okay. But initially you are definitely going in an inefficient way. When there are better products available, more importantly.
Yeah. Also that the corpus is locked. That's like, I think, the killer, right? I mean,
you can't
1 crore, it's just stuck there. And even if you need it for medical emergencies, you don't have access to that money. That's like, I think, the bummer.
Absolutely. I'll probably prefer FDs over it, because in FDs, at least you can break it in emergency and take the money. Here you've locked in. So it's not really a comfortable feeling. So you get the certainty of cash flow, which itself is not very, very high. And then you don't have access to your capital. I don't think it's a big win-win.
Comfort is not necessarily safe.
Absolutely not.
Yeah. So, I mean, I understand this thing about FDs and annuities, but how do I withdraw from my capital? You know, that is very, it was a hard work, sweat and blood and tears have gone into building that corpus. How do I withdraw out of it? So all these new ideas, new age ideas of systematic withdrawals and all, do consider some amount of capital withdrawal, right? So that's a little uncomfortable for many people.
So again, whether you withdraw from the capital or only from the interest, or how much does the capital start depleting after a point, again, depends on a couple of factors I mentioned earlier. What is the rate at which your inflation is growing, and what is the rate at which your portfolio is growing?
Correct.
If inflation you're considering at 6-7% and you're comfortable that this is how my expenses will grow, and if you've created a portfolio which is around 7-8%, which doesn't need a lot of equity, which means you're not taking market risk, you're fine. You will not essentially have a lot of trouble. You can live with your interest. But the assumption we have made is that this corpus we are talking about, like you asked earlier, how much will a 3 crore give me to live comfortably? The assumption is this 3 crore is for your living expenses.
Okay.
So till the time you live, this 3 crores purpose is to give you cash flow till that last day on this Mother Earth. The purpose of 3 crore is not to leave behind legacy assets.
Okay.
If you also want to have legacy assets over and above living expenses, then you're changing the starting point. Then you're changing the objective. So portfolio design is to meet an objective. So if it is only about living expenses, then 3 crore is enough. Assuming 6% inflation, 7% rate at which it grows, 30 years, you don't have to worry. You will get that 1 lakh comfortably. But if you suddenly add in a factor saying, oh no, but I was also hoping that I will leave behind 1 crore each for my 2 grandchildren, you've changed the problem statement, right? It's a mathematical calculation. So if you change the input, everything will change.
That's my job.
Then your starting point is not 3. Then you're saying, okay, I'll need probably 4.5 crores, let's say. 1.5 crore I'll put aside, which will grow and become 2 crore at some point, which I'll give it to my grandchildren. This 3 is still for my living expenses.
Correct.
So once you understand this purpose of this X crore corpus is for my living expenses, then you start to understand that this will go to zero eventually. And we are just hoping that it will go to zero much after you are not around. Yeah, that's the thing. It will go to zero. It's a question of when. So purpose is very important. What are you creating the corpus for? So if you're creating multiple buckets, you will have to have multiple starting points of money.
So that's the whole thing, right? In House of Alpha, I do the adding new goals into the plan, and then it's his problem to figure out how to handle it.
Correct. So that's why in House of Alpha, we always put investment plan after financial plan.
Correct.
It's an answer to the question. It's like, I want this. How do I do this? Now I have to create a portfolio for that.
Yeah.
Sometimes it is not possible. So we go back to the client and say, I don't think your grandchildren will get 1 crore each, given the numbers. Maybe you'll have to compromise to 25 lakhs
Set the
each.
right expectation with them.
Absolutely. Because we are talking about numbers. We can bring in as much emotions as we want, but numbers don't lie after a point.
Correct.
People hate Excel sheets, but I thrive on them and I decide on them, and they don't lie after a point. Bad assumptions and bad logics will bring out bad outputs. So we have to be realistic at every point.
Correct. Okay. So you dissed fixed deposits, you don't like them. You dissed annuities, you don't like them. So what really, you seem to have some liking to debt mutual funds, but what is your strategy? I mean, how will we generate regular cash flows adjusted for inflation and then make the money last and then be tax efficient and then provide for liquidity? How is it possible?
Correct. So in your question, you have listed down the important factors that has to be considered. We have to consider liquidity because this is a withdrawal portfolio. We have to consider taxation because tax is a cost which nobody wants to pay, especially if you're not really earning any active income. You have to consider preservation capital as much as possible. You have to consider longevity of this wealth. So considering all of this, you're looking at products that fits into all of this bill.
Correct.
The main logic in which I would design a retirement portfolio is to replicate their pre-retired cash flow in a post-retired time frame. Meaning, if a client was getting monthly income from salary, you try and give them the same cash flow on the same day so that there is consistency in money hitting their bank account.
Is that necessary? Because they might have a little surplus in their cash flows, right? When they are earning, they may not be necessarily spending. Should you pick up the last earned salary or the last spent money?
No, I'm not talking about the last earned salary. I'm talking about the timing of it. I'm not saying that if you are earning 3 lakhs, that I'm trying to replicate 3 lakhs.
Okay.
We've already arrived at the figure that with this corpus, as we calculated earlier, you will get 1 lakh. Now, we want to create the certainty of that 1 lakh hitting their bank account every month.
Okay.
If you can do that, it gives you a lot of comfort that, okay, things are in control. I am getting cash flow every month. I don't have to panic because the worry starts from there. Am I getting the money? Where will I get my next outflow from, etc.? So create a portfolio which is designed to give you this consistent cash flow. Now, what the portfolio should have depends a lot on what is the rate you're expecting from the portfolio. As I said, at 6% inflation, if your portfolio can grow at 7% post-tax, you're comfortable. You will last till 30 years, no problem. To earn 7% post-tax, you don't need a lot of equity.
No.
You will just need a little bit of equity. You can have much more debt. But scenario 2, somebody's inflation is 9% because their lifestyle is different. Then I need a portfolio which gives me 10, 11% post-tax. You will have a larger chunk of equity. So that's the starting point. In terms of products and how it will work, I like to create certainty of cash flows, as I said. So the first year of whatever you need goes into very, very certain products where you know you will get this much rate without eroding your capital and should be as tax efficient as possible. So my pick for that first year cash flow is something like an arbitrage fund.
Okay.
It's a part of mutual funds. They will always say it is subject to market risk. There are black swan events that can hit the returns on a particular day. But if you zoom out, it will give you returns which is close to your FD. Much better taxation at equity tax rates, which is better than FD tax rates. And you know that you will get this cash flow every month. So the first year of expenses, if you want to be conservative, even 18 months of expenses, you can put in the arbitrage fund and keep withdrawing every month.
Okay.
You don't want all the money there because you're compromising on higher returns. The money that you need after 10 years, the money that you need after 20 years need not sit in a arbitrage fund.
Correct.
That is where you can have the luxury of having equity. The good thing about equity is it can give you double-digit growth rate. The bad thing about equity is it can have fluctuations. It can have temporary losses because of market crash. So anything that you need in the next 3 to 5 years, conservatively, I wouldn't want equity for that.
Okay.
So first 1 year, I'll put an arbitrage fund for it. 2 to 5 years, I'll have a mix of few products. I'll have something like debt mutual funds, which are short-term mutual funds essentially without much capital risk. We can add in a product in the form of commodities. We can have some small exposure to gold and silver.
Is it? Okay.
You can redeem it at the right time, especially when the market goes up. And you can have a very interesting product called real estate investment trust or infrastructure investment trust, which gives you quarterly cash flow. They are not as certain as a fixed income product in terms of how much you will get. You will have fluctuating returns, but it won't be negative returns.
Okay.
You will get something like probably 5-6% per annum every quarter, plus the capital appreciation linked to real estate.
Okay.
The idea of doing this is also diversification.
Okay.
You're not putting all the money in only fixed income, which is connected to interest rate risk.
Okay.
Because if interest rate drops over a period of time, your inflow also will drop.
Okay.
You want some exposure to gold and silver, which is also precious commodities. You can also have an exposure to real estate investment trust or InvITs.
So different asset classes.
Yeah, so you diversified asset classes. You've diversified asset classes, which ensures that the correlation risk is not high.
Okay.
If gold is not doing well, fixed income is still doing well. Maybe in an environment where fluctuations in volatility is happening, the global economy is going through turmoil, the gold prices can go up and can give you that extra returns. So you've diversified asset classes. You haven't taken equity risk. So your 2 to 5 year bucket gets created like this. As you go closer towards the end of 1 year, you move certain assets from this bucket back to arbitrage fund. So at any point, the next 12 months visibility is from arbitrage fund. You keep moving some assets.
So every year you have to do some action to the flow.
Absolutely. This is a very, very important aspect. People generally think that when your income is active, when your life is very active as a working couple or a working person, then your portfolio has to be very active. And when you go into a passive mode where you're kind of not having active income, then your portfolio also becomes passive. It's exactly the opposite.
Okay.
If a 30-year-old person comes to me and if I tell them, invest all your money in, let's say, index funds, equity index funds. Let's assume this 30-year-old person is creating a portfolio till 30 years, for 60 years. I'll say, don't touch it. Be passive. Just sit back. I don't want you to look into it at all. That will work. But a retirement portfolio has to be active. You cannot just leave in some asset classes and sit back because you need cash flow year after year. So you have to be more active. So there's a lot of myth around retirement portfolio being passive. Will not work. So at the end of year, you'll have to take some money from the other bucket, put it in the first year bucket. Let's assume in the first year itself, 6-8 months down the line, one of the products that you had put your money into is, let's say, gold ETFs. And gold goes up by 20% because of some war situation. Book some profits there. Because you are only expecting 7-8%. The asset class is suddenly giving you 20%. You have an opportunity of booking some profit.
And it's not that gold is going to become a multi-bagger or anything.
Exactly. And the purpose is not growth. The purpose is not I want to stay with gold for the rest of my life. The purpose is how do I use all of this to generate cash flow? So constant booking of profits become very important, which I may not suggest to a 30-year-old who's building a long-term portfolio. He or she can forget it.
Interesting.
A retired person cannot forget it. You have to be active enough to say, oh, this asset class has gone up, let's book profit. Same with equity. So anything more than 5 years, 6 years, 7 years money that you're saving for, you can take equity exposure if you want to, especially if your inflation rate is 8 or 9. If your inflation rate, I go back to it, if it is 6, you only want 7% from your portfolio, you're okay without equity at all.
Inflation rate being one thing, also withdrawal rate, right?
Yeah.
So if I need only 1 lakh and my lifestyle can be accommodated within that 1 lakh, very well.
Absolutely.
But if I need 2 lakhs, then I can't do
then with the same corpus, you
it's
cannot.
not possible. But the corpus is fixed, na?
Exactly. So then you'll have to chase higher returns, which means a part of it has to go into equity. You can take equity risk even as a retiree because you are 60 today. You're talking about living till 85, 90. It's still a 25-year horizon.
Yeah.
You need to have components which has to last for 25 years, and that is equity. So it's absolutely fine, even if a retirement portfolio has 50% equity. There is nothing bad in it. There are these thumb rules which says that you should not have too much equity. That is not true. If you have enough cash flow visibility for the next 3, 4, 5 years, equity will do what it will do. It may have a crash. It will recover. For a 10-year, 15-year, 20-year horizon, Equity is the best asset class. It will then give you the flexibility of expanding your expenses also if you want.
Yeah.
Equity can be in simple index funds, or if you have good advisor, or if you know the market, you can pick active funds, stocks, etc. So I'm not going into components. Broadly, the asset class has to be arbitrage funds, short-term debt funds,
And equity.
commodities, REITs, and equity. This is it. You don't need anything else for a retirement
Nothing
portfolio.
fancy. But I really like what you said. Hashtagable, active life, passive portfolio, passive life, active portfolio.
You have no choice.
Yeah.
The first, you can still have active life, active portfolio. You can play around. But a passive life,
Passive
retired life,
portfolio.
passive portfolio will be absolutely dangerous because you're playing with finite money. You have to maneuver it on a very regular basis. I would say probably every year. If you have components like equity or commodities, whenever the rally happens, gives you more than 11-12% expected rate, book some profits, you need cash flow. We are not looking at legacy assets here.
Okay. So a legacy, if the plan is to leave behind legacy, you start with that. So out of the 3 crores, I'm going to leave behind 50 lakhs. So I'm going to try and live within 2.5 crores. And so I'm willing to adjust my lifestyle accordingly and do all of that, right?
You are living like classic economics. You're living now in scarcity and you have choices.
Choices.
You have to make choices now. You can't
choices.
tick all the check boxes and say I want everything.
Yeah.
Not possible.
Not possible.
At retired life.
But I've also heard this arbitrage and then debt funds and then equity. So we were just doing these numbers, trying to run the Excel sheets, and an all equity portfolio SWP was lasting for much longer than the way you were talking about arbitrage and debt funds and equity, right? So isn't it inefficient to do this bucket strategy thing?
So again, it depends on the purpose. If you are willing to take risk, and I'll talk about that risk, and if you go all in equity and start withdrawing from it from day one, the advantage is equity as an asset class can grow at 12, 13, 14%, whereas fixed income is only going to grow at 6, 7%. So
and you put away a large chunk of money, 3 years, 4 years expense in that fixed income.
Exactly. So you're kind of looking at it and saying, oh, I am probably getting lower returns on this chunk of money.
Correct.
But the problem with equity is it can crash anytime. So you are withdrawing from equity. You're assuming that it will have a constant 12% linear growth rate. That doesn't work with equity. There is something called as a wrong way risk that can hit you, which means that you're hoping that it will go up, but on a particular day, the markets crash by 25%, let's assume, and it takes 5 years to recover. All your calculations will go for a toss. In that calculation, which I told you earlier, 3 crores corpus, 1 lakh rupees withdrawal every month, 6% inflation. If I add equity in this portfolio and at some point equity crashes by 20% and recovers only after 5 years, that 30 years longevity goes to 27 years. So there will be impact. There will be impact of a market crash because again you have finite money. A part of it has just evaporated. To recover it may take 3-4 years, but time is probably not something you have at that point. So equity is a good component of the portfolio, but 100% equity, if you're living in a very tight number game, will not be very efficient. I wouldn't recommend that to anybody.
The sequence of returns risk, right?
Absolutely.
Early years, if you lose money on a...
Absolutely. So if early years you got 20% compounded, amazing. You can suddenly start to live more lavishly. But if the first 8-10 years of your retirement portfolio, the returns is only 7-8% from equity, then it might probably not be the most efficient way.
And you've already withdrawn enough money in the first 10 years, you don't have
get
enough.
The compounding benefit also on that. So it's always good to have next 2-3 years conservatively in fixed income. I know it will hurt the portfolio returns, but again, I'm going back to it. The purpose is not growth and legacy assets and leave behind something. The purpose is to efficiently ensure this money will last your lifetime.
Yeah.
So liquidity over growth at this stage of your portfolio construction.
Yeah. So, I mean, the mindset changes, right? So we're not looking at accumulation, growth, or being aggressive, but the portfolio should provide comfort. It should support the lifestyle that you want. And you made a very, very pertinent point about balancing return requirements and risk. I mean, of course, we've met clients together and we do see the risk profile of a couple being very different, you know.
Yeah.
So the man's been working all his life, Now the woman wants to start traveling,
Yeah.
but there is this fear of, withdrawing more.
Yeah.
So balancing this is, of course, a lot of coaching and other
Correct.
things. But in the portfolio, is there something that we can do to do this balancing?
Not really. As I said, a lot of this initial aspect of getting both husband and wife in a couple to come together with common goals and common aspirations, whatever they are. As you said, maybe the wife wants to travel more now because she doesn't have the responsibility of the kids. Maybe the kids are away and well settled. The husband is now probably enjoying his retired life with his friends and family. So the wife is like, I want to take probably a solo trip every year. They'll have to budget it. The investment portfolio, as I said earlier, can only react to it. You give me whatever financial plan you want, like we do in House of Alpha.
Yeah.
I'll try to do the best thing possible out of that. If we can do it, why not? But sometimes you have to compromise. The ball goes back to the court of the couple. Then they'll have to discuss and say, okay, you know what, maybe once in 3 years is what I can do. Maybe not once in every year. Things like that, you'll have to kind of change, modify, come back. Investment portfolio can be created, but just to fit in whatever aspirations you have, let's go with a very, very aggressive portfolio with finite money is not really a good strategy. So you have to adjust the wants more than adjusting the returns. Because returns will come with risk. You cannot wish away the fluctuations. You cannot wish away crashes if you are in equity. So you will have to, unfortunately, at some point adjust your wants. You have your needs, which we will ensure that the portfolio can take care of, but wants anyways are flexible. So you'll have to probably work around that.
For it. Yeah, so that's precisely why we say don't start your retirement plan with a calculator, but start with the calendar. So pick up your calendar, identify activities that you want to do, put them in there, see how they will pan out, estimate the costs, go back to the financial planner or the investment advisor and say, this is what I want to do in my life, build me a portfolio that will support this.
That's a
desire
very
of mine.
Powerful approach of going about it.
Yeah.
It has to start with the mindset again.
Yeah.
It's like a reset. Now the things have changed. You are now not looking at what you were looking at the past 30 years. It's like now playing a new test match. The last match is gone. This pitch is different. You have to bat differently. Maybe you have to change the team also, which means the portfolio component has to change. As they say, horses for courses. So if this phase of your portfolio needs more debt, and that means lower returns,
So
maybe that is the most ideal thing to do.
Yeah, fantastic. I think this was a very useful conversation, and we spoke about various products, building, stacked bucket strategies, the risks involved, and like we always keep saying, money is only a tool. It helps you live the best life possible. It's not the end; it's only the means to an end, and that's how you do refinement. Right.
Yes.
So thank you so much, Harish, for joining
Thanks,
this
Bhuvanaa, for
conversation.
having me. Thank you.